Interest rates have never looked better for savers, but you shouldn't put all of your eggs in one basket, or CD. With the Federal Reserve's recent quarter percentage point rate hike, interest rates have reached a new high. At 5.25 to 5.5%, this is the highest the benchmark federal funds rate has been since 2002. This era of higher interest rates makes borrowing money expensive, but it can also make saving money more lucrative. Interest rates may be near a cyclical peak, creating an opportunity for some to lock in higher yield savings. This could be especially important for retirees living on a fixed income who want the security of a guaranteed rate. Since rates are cyclical and are likely to decrease at some point in the future, I would like to talk about how you can capitalize on the higher rates while they last. Hi, my name is John Gigliello, Certified Financial Planner with the Albany Financial Group, and you're listening to Invest in Knowledge, a podcast about all things financial. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. Only through education, action, and accountability can you build the confidence and security that you need to live a satisfying life. In today's episode, I'm going to address the upside of higher interest rates, particularly for those who have reached the retirement phase of their lives. The inspiration for this episode comes from a Wall Street Journal article which addressed this very issue on April 18, 2023. As rates rose continuously over the past 18 months, savers piled into government I-bonds, high-yield savings accounts, and bank certificates of deposits, chasing better returns on their money, the Journal reported. Despite the high interest rates, whether CDs make sense depends on how soon you need to access the funds. If you may need the money in the short term, high-yield savings could be the best bet, since pulling money out of a CD early incurs penalty fees. Treasury securities may make sense for other investors, especially those who live in states with high taxes such as New York or California, since, unlike CDs, they are generally exempt from state and local taxes. The current average yield on a 91-day Treasury bill is 5.27%. In either case, the high interest rates will not last forever, though. Retirees, especially, need to plan for the next time short-term rates and the cash they generate decline. That means creating diversified portfolios that can both generate income and produce the appreciation necessary to keep up with the rising costs of living over the long term. Time horizon is a key concern in investment strategy for retirees. How long do you expect to need the money? When looking at a 10 to 15-year investments or longer, the portfolio will likely need some exposures to equities or stocks in order to keep up with inflation over that long time period. Yields have risen as the Federal Reserve lifted its benchmark rate to slow growth and fight inflation, and they may remain high for quite some time. But there are already signs that growth is slowing, and eventually we will get to a point where the Federal Reserve has to change course and bring rates down. Experts believe the Fed's benchmark rate could drop to 3% or lower within a couple of years, pulling down yields on bank and money market accounts, according to the Wall Street Journal article. An investor could, and probably should, lock in current high rates with a 4 or 5 year bank certificate of deposit, assuming the funds are not needed sooner than the maturity date. But keep in mind that when the CD matures, an investor could face the prospect of rolling over the funds at a much lower interest rate. CDs generally pay higher interest rates than savings accounts, but require savers to commit to locking up cash for a set period, typically 6 months or a year. Pulling out money early can incur a fee. As of July 25th, CDs are yielding up to 5.3% for 1-year terms and 4.5% for 5 years, according to Bankrate. Though these higher rates make it more expensive to borrow money for a home or car, the Fed's move make yields on savings much more attractive. Though it is too soon to know if rates have peaked, CDs give savers several strategies for short and longer-term returns. CDs are offered by banks and credit unions at varying rates for terms ranging from months to years. Savers can compare rates with their bank on sites such as bankrate.com. Since savers don't know which way rates will move next, one strategy is to create a CD ladder by buying a series of CDs with progressively later maturity dates. This way, a portion of your savings matures each year and can be spent or moved into other investments as rates change. Now, investors can also consider what's called a barbell strategy, which splits an investment into 2 buckets. One part goes into longer-term savings, like a CD, and another portion goes into shorter-term CDs or other investments. While it might seem like a no-brainer to put your money in a CD with a guaranteed interest rate, right now you should not put all of your eggs in one basket, so to speak. If all of your funds are tied up in CDs, you could miss out on recoveries in stocks and bonds fueled by declining rates. This is why a balanced portfolio is so important. The U.S. inflation rate recently stood at around 5%, and it may remain elevated for some time, experts say. As short-term rates eventually drop, returns from a cash-heavy portfolio may not offset the rising cost of living. Historically, equities have provided a decent source of growth. For example, from 1926 to 2021, a 60% stock, 40% bond mix produced an average annual portfolio return of nearly 10%, despite a sharp drop in stocks early in the 1930s, data from Vanguard shows. A more conservative 30% allocation to stocks would have generated annual returns of about 8%, according to the data. This is according to the journal article that I've cited. After poor performances last year by both stocks and bonds, investors understandably may be wary of buying either. But financial planning should be driven by someone's goals, timeline, and comfort with risk, not by interest rates or expectations about market performance, experts say. Investors who don't already have a long-term financial plan should seek out a qualified professional to help develop one. It's not a good idea to wait for what seems like the best time to get into the markets, since few people ever get the timing exactly right. Of course, we always encourage you to take part in the financial planning process to help secure your financial future and, in turn, feel optimistic and proud about your accomplishments. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal challenge into a gratifying journey. Thank you for listening to this episode of Invest in Knowledge. Have a great day. The facts and statistics in this podcast episode were compiled by the Wall Street Journal. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing includes risks, including fluctuating prices and loss of principal. No strategy assures success or protects against loss. The economic forecast set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. CDs are FDIC insured to specific limits and offer a fixed rate of return if held to maturity, whereas investing in securities is subject to market risk, including loss of principal. Government bonds and treasury bills are guaranteed by the U.S. government as to the timely payment of principal and interest and, if held to maturity, offer a fixed rate of return and fixed principal value. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk.